Let's see. Okay, hello everyone. Hi. Oh, okay, it goes 9, 10, 11. Okay, hi everyone. Hello. Thanks for joining us tonight. And right now we have about 16 of y'all, so we're expecting much more. So let's give the rest more time and for them to trickle in. And yeah, then we'll get started in probably about at 8:02, 8:03. So 26. Okay, we have good number. Okay. So yeah, before we get started, right, for those of you here, nice to meet you all. I have a question for those of you here who's tuning in. I want to know, right, is this your first time tuning into our webinar? So let us know in the chat section whether is this your first time, your second time tuning into our webinar. And by the way, can you all hear me? Can everyone hear me, right? Everyone can hear me clear, right? Let us know in the chat section if you all can hear us, hear me clear. Can hear? Chat disabled. Okay, how come the chat is disabled? Give me a second. Oh, okay. Okay, we have enabled it now. Can you all try? Give it a try. Try to chat in the leave us your message in the chat section. Okay, hello. Hi, Raihan. Hi, David. Hi, Owen. Hi, everyone. Yeah, I have a question for everyone here. Before we get started at about 8:03. So is this your first time tuning into our webinar or your second time? Shouldn't be the third time because this is actually our second time doing the webinar. So if it's the third time, it's probably the wrong webinar. So first time. Okay, lots of first. Hi everyone. Hi Sally, Owen. Hi, first time. Okay, great. So I'm also seeing lots of new names here as well. And I'm also just curious as well, right? Is this your first time hearing about Halogen Capital, or you've heard about us from your friends or from social media and stuff, but you probably want to know more? Is this your first time hearing about Halogen Capital? Let us know in the chat section. Anybody? First? Okay. All good? Yeah, if you all heard me, is this your first time hearing about Halogen Capital? Let us know in the chat. First time, okay. Okay, great. So, okay, I think there are quite a number of you here already. Give me a second to check. Okay, so we have about 33 of you here. All right, so let's get started perhaps. So, okay, test, okay, so let's get started already. So there's quite a number of you here. We are expecting more, but they'll be joining soon. So hi everyone, good evening, and a huge welcome to all of you joining us tonight. So my name is Jiaying. I'm from the Halogen Capital team, and I'm your host for tonight. So nice to see y'all, nice to meet y'all if you're here for the first time. So yeah, so as y'all already noticed, or you might not have noticed, we're actually nearing the end of 2023, right? So I think most of us, or most of y'all might be reflecting or feeling retrospective about the year, and at the same time, while doing this, I've also been seeing a lot of this very particular question on like forums and Reddit and Twitter and stuff, asking this one very particular question, which is how should they be positioning themselves for 2024 in terms of their finances and investment portfolio? And I'm pretty sure this is why most of you are here as well, because you want to understand, get our thoughts on what lies ahead in the first half of 2024, right? So that you can make a better and informed decision for yourself. So with that said, of course, I'm not alone in this for this webinar today. I have two very wonderful speakers with us. But before I introduce them, I have another question for everyone here. So my question is, how many of you have already started investing, and I'm just curious as to how was 2023 for most of you in terms of that. Let us know in the chat section, and would love to know. At the same time, if you're not an investor, are you looking to start investing in 2024? Perhaps let us know in the chat section. So why do we want to know this is so that we can we would know what kind of questions that we should address, and how at the same time what kind of areas that we should explain more, and how we at Halogen Capital can be of help to you. So let me look at the chat section. Okay, anyone, like, is this your, maybe share with us, don't be shy, share with us, is this your, are you an investor yourself, and how was 2023 for you? Anybody wants to share in the chat section? Anyone? Or you're taking some time to think? Okay, it's okay. While you take some time to think, let me go ahead to share, to also introduce our speakers first. So yeah, let me introduce our speakers, our two very special guests for today, to enlighten us about what lies ahead in the first half of 2024. Couldn't be more honored to introduce them. So first up, we have Fuad. So Fuad, meet Fuad. So he's our Executive Director and Fund Manager at Halogen Capital. So a little bit about him. He has over 15 years worth of experience in asset management and has successfully managed over 2 billion ringgit worth of assets for a diverse clientele. So you have your government affiliated organizations, to family offices, to small medium enterprises, and also high net worth individuals, together with private banking clients. So lots of clients. Fuad is very experienced in what he does in asset management. At the same time, not forgetting our second speaker, which is Colin. So everyone, meet Colin. Colin here is our head of trading at Halogen Capital. So he was previously the head of foreign exchange trading at OCBC Bank Berhad, and he brings to Halogen more than 10 years worth of experience in global markets with strong foundation in FX spot and option products. So aside from that, he has also a wealth of experience in global macro and cross-asset trading, which includes cryptocurrencies as well. So everyone, please meet Fuad and Colin. Fuad and Colin, you want to say hi to everyone?
Hi, everybody. Thanks for joining us.
Hello.
Hello, hi. Okay, so all right, I think without further ado, I'll pass the time to you, Fuad and Colin. And to those who are tuning in, leave us your questions in the Q&A section, in the Q&A box, and then we'll answer them. We'll go through them during the Q&A session later. So let's all keep this session interactive. Don't be shy. Just ask us either in the chat or the Q&A section. So over to you, Fuad and Colin.
Thank you, Jiaying. Good evening, ladies and gentlemen. Thank you for joining us at Halogen Capital this lovely evening for our market and crypto outlook for the first half of 2024, because things are going to get interesting and we don't dare forecast too far ahead. That's why we're only sticking to the first half. Jokes aside, I'd like to start off by giving you the lay of the land. Before we go into the meat and bones of our presentation today, we will cover areas that we think are the key drivers for markets. But conscious of time, we're not going to deep dive into the whys, although you're welcome to ask during the Q&A at the end of the session. Of course, you have the little chat box in there, so we'll pick those up. Last but certainly not least, we will give you a view on how to position, because we believe it's best to leave you with some kind of actionable item. A bit about myself. I used to be a bond fund manager for 14 years, and it continues to be my area of interest and expertise here at Halogen. It's well known that bond guys probably understand macroeconomics better than equity guys. Equity guys, feel free to call me out, because we have to watch out for what happens with interest rates. But I will let you be the judge of that. Later on, I'll be joined by someone who is probably more in touch with macro than I am, my colleague Colin, our head of trading, because if there's anyone who knows macro better than the bond guy, it's the FX guy. So I'm sure you'll be keen for his section as well. But for now, you'll have to make do with me, and I'd like to start with the big picture macro, global macroeconomics. One sec, yeah? And in essence, we are being driven by what's happening in the US, I think more so than ever before in my career thus far. It's useful to do a pulse of what's happening in the world's largest economy. What does the central bank say, the Federal Reserve? And in their opinion, it's one that's shared by many practitioners. The US looks to be slowing down in growth in 2024 from the 2.1% growth that's likely to be seen in 2023 to 1.5 in 2024. And if we look at some of the other frequently released data points such as GDP Now, a really cool figure that I suggest you guys bookmark in your browsers. It's already saying that the slowdown is kind of upon us already. It's already looking at 2% flat, right? And perhaps this sets up for some kind of acceleration in the first quarter of next year. So if we look at what JP Morgan is saying, yeah, it does kind of point to a sustained decline over here. But of course, it is an averaging out of what's happening. But I think across the consensus, it looks like it's slowing down, right? I think that's the key takeaway. So with growth slowing down, does this mean that inflation will slow down as well? That is a key component to think about, because inflation is that word that everybody's scared about. It's the one word that has taunted us over the past 2 years. The headline inflation number seems to be quite stubborn, and no doubt this hasn't helped. It hasn't been helped by the geopolitical risk that has emerged. Also, OPEC keeps cutting supply, which is quite naughty, and keeping oil prices within that 70 to 80 range if I'm looking at the West Texas Intermediate. And also on the surface, it does look like core inflation is being tamed, right? But if you look on the right-hand side, charts like from Goldman Sachs over here, it does look like core inflation is going down. But the overall gauge, as I pointed out earlier, remains unchanged in October. So the headline inflation does seem to be quite stubborn. However, the core inflation is talking, is looking more towards that the Fed is getting closer towards its 2% target. However, when we dig a little bit further and we look into the US labor market, we are seeing signs of job losses, because previous month numbers on the non-farm payrolls keep being revised downwards. So the blue here are the actual number releases, and then the whites are what's happening in terms of the adjustments. And there's a few times that you've had major downward adjustments. And these are job losses potentially triggered by higher wages. So, companies can't afford to pay, so there's time to cut some positions. And we all know that high wages actually translate to inflation. I think you can obviously see that it's not such a straightforward inflation was my costume for 2023. That's a great little quip by Yu Xiang in the chat. So yeah, please, more quips. We would like to see that. But yes, higher wages do translate to inflation, but you're also seeing job losses. So there is a little bit of a balancing act that's happening here. But if we were to look at the overall situation in terms of growth and inflation, it does seem to point to the Fed being almost done with their interest rate hikes, right? So that's number one. I think the key takeaway is that the Fed is done with the rate hikes. But number two, I think rate cuts may not be coming so soon. And we'll dive a little bit into why. So first, as I mentioned, our view is, okay, the rate hikes are probably done for now, but the rate cuts may not be coming so soon. And that is a potential mismatch in the bond and derivative markets right now. Because if we look at the probability based on the market traded instruments, by first half of next year, the Fed already thinks that the market already thinks that the Fed will cut interest rates. If we look at the right-hand side chart over here, so yes, meeting date in December, I think very firm consensus that there's no change, and that continues until March. I'm pointing to the blue figure here, so that points out the consensus. And then by May, market's already expecting one cut. Of course, a slight majority, 47 to 34. And then, yeah, you can see that it continues all the way till the end of next year. They are expecting a cumulative of 4 rate cuts by the end of the year, right? And I think partially of why this mismatch is happening is because fund managers as a whole have been bearish this whole year. With the low in sentiment on this left-hand side chart over here, FMS means the fund manager survey that's conducted by Bank of America. It's one of the best surveys to look out for in terms of sentiment, because it's people who manage money professionally and where they put it to work. And the low in sentiment was in March of this year with what happened with Silicon Valley Bank. And remember, that was bad. 100-plus-year-old bank collapse, Credit Suisse. And that has been inching up slowly towards the end of the year. And we see this November here that's creeping up. Of course, it's only just slightly better than some quite terrible situations like COVID and trade war and all that. So that's how sentiment has been. So now that there's this little opportunity, a sign of good markets, these green shoots, I think we think that fund managers are going to go for it. This deployment of capital and pent-up investing could spill over past the end of the year and into the first quarter as well. So that's why we say we expect sideline cash to be deployed because of this window of opportunity. One sec, yeah. But I don't think that all is going to be so smooth sailing in the beginning of 2024 because of the US election that happens in November next year. It looks to be hotly contested. Biden's approval rating is not good, and Trump is waiting on the wings to capitalize on this. And more importantly, for today's context, it tends to mean that activity is backloaded. So Colin came up with this simple but very powerful chart. It only has two lines, right? One dark blue and one lighter blue. And this has data since 1927, looking at the S&P 500, and there's a clear trend. So dark blue is every year since 1927, and the lighter blue are specifically only election years in that same time frame. And what we see is there is a trend where in election years, it kind of stays quiet for the first half of the year. And then there's this huge catch up in the second half of the year, particularly in those last 2 months as well. And because of that effect of a low base, in a sense, it's actually a faster, you get higher returns in an election year, but it is usually backloaded. So this positioning or this seasonality may put a damper on that global fund managing position that I described in the previous slide. And also, if we look at geopolitics, I mentioned that geopolitics are making things a bit complicated. There is much higher geopolitical risk in recent times. And I hope that you didn't get into any unnecessary squabbles with your loved ones, but let us try distill the impact on markets. Palestine and Israel on the left-hand side, there are implications for oil, higher oil, but that has been dissipated recently because of the slower growth narrative that I talked about in the first few slides. Russia and Ukraine, the impact on inflation is less now because it's already past the 1-year mark. So year-on-year data no longer shows that kind of impact, and it's kind of already bled through, I would say. And on the cooling down side, very interestingly, we've got US and China. I know some people might be talking about how Sleepy Joe has accidentally said some not nice words, the D word, the dictator word. But we think as a whole that US-China relations are actually cooling down. At the summit recently, it points to a softening stance instead of, the very hot rhetoric of last year. Think of when Pelosi visited Taiwan, right? Because she went to meet Biden. And of course, forecasting these matters is nearly impossible. So they remain a risk to markets because all of these actually have the risk to evolve into something larger and implicate many more countries. So, but at least you have over here our overview of these 3 points of geopolitical risk. And you can't talk about global macro without talking about China, right? Speaking of China, I like to reflect on how it's doing lately. There is no doubt that China is slowing down, and people are waiting for the big reopening and the recovery. In particular here in Malaysia, we're all talking about the domestic tourism industry. But it does seem that China's role is evolving, right? Because if we look at a very, very long-term chart of China's exports, exports are slowing down for the first non-recessionary time. Because we look at some of these points where, say, the global financial crisis, the first round of trade war, and then COVID, this was really kind of the first non-recessionary time since China joined the WTO in 2001 that exports have slowed down. And with China's growth slowdown, does this mean that it will help the inflationary environment? Because we talked earlier about how slower growth tends to bring down inflation. Unfortunately, we think not. What we saw in the previous slide was a byproduct of deglobalization. And I think that's going to be a key theme going forward. And that means that there is a diversification away from China in global supply chains. This is showing up in other data as well, like the chart that I'm showing here. China FDI is negative for the first time since 1998. Which is awfully close to China joining the WTO in 2001. So at this point, it's really hard to chalk that up to coincidence only. So what does deglobalization mean? Structurally, it does mean higher inflation. It is taking away countries from being on that efficient path of, efficient deployment of capital. That whole adage of country X makes slippers very cheap, but the other one makes semiconductors very cheap. So if you were to force the guy who makes slippers to make semiconductors, they'll be super expensive. And so that's what I mean by structurally higher inflation. So that's something to look out for. But I think to wrap up about China is in a transition where it will move away from exports and focus on domestic consumption. So what was a pretty good 2023 is also starting to look scary. So this is China's consumer spending. It's also starting to look scary towards the end of the year. Sure, the housing bust was a key reason, but if we look at the bigger picture, there is a potential breakdown of the social contract. In China, it used to be as long as individuals don't criticize the government, they'll be allowed to make money. But after many crackdowns, you're talking tech, property, now ministers and doctors, patience is wearing thin. Okay, so I think to wrap up, our key takeaways is that number one, China's recovery may not be as significant as the Malaysian Tourism Ministry is hoping for, and the rest of us as well who may have businesses in China. Number two, the decoupling does mean potential higher inflation in the long run. I will temper this fact again by pointing out that China seems to be eager to improve international relations. So perhaps we are seeing the early signs of change. However, it's too early to tell now, and I feel it's too early to position for that right now. So to wrap up in terms of our macro outlook, we expect US markets to maintain a bullish bias, and a lot of other markets will have to follow the tune of the Pied Piper, who is the US in this case. Of course, everyone's talking about, is it a recession or is it a soft landing? And we think that the way that things are shaping up right now, Goldilocks is the likely environment in the first quarter of next year. The Fed is almost certainly done hiking. We have to put almost there because sometimes economists get it wrong as well. US presidential election years are on average bullish. There are some exceptions, like the global financial crisis of 2008. Some potential thawing of US-China relations, despite the press surrounding the high-tech exports and all those kind of things. So this actually augurs better for the US side than it does in terms of China, which does have that little bit of the political overhang. But the risks to our view, number one, market pricing has gone perhaps a bit too easy, indicates that financial conditions are too easy. Does that mean that the Fed will have to reverse on the tune and then feel they have to put out more hawkish statements? That is a threat. Acceleration of inflationary pressures, we talked about some. Services is growing quite strong, especially the service sector wage growth. And of course, you do have some cost push driving factors such as deglobalization, etc. And of course, the escalation of geopolitical conflict that is never good for these kind of situations anyway. So yeah, next I'd like to move on to Malaysia and talk about what does all of that mean for Malaysia, right? Of course, Bank Negara expects growth for this year to range somewhere between 4 to 5%. And we look at the recent figures. So first quarter was 5.6, second quarter is 2.9, and the third quarter came out at 3.3, which is slightly better than the second quarter. But if you look at those figures, you need a pretty fantastic fourth quarter to end up anywhere close to 5, and we don't think that that's the base case right now. Some factors that are supporting growth, and especially the domestic side, favorable labor market. So we're close to being at pre-pandemic levels of employment again. And you've got the continued transport mega projects. You've got your ECRL, LRT3, so on and so forth. However, in an environment of slowing down growth, you saw what's happening in the US and you see what's happening in China. Those already account for, well, close to 40-50% of Malaysia's exports, for example. That's going to hurt. And also commodities particularly are slowing down because people are expecting this global slowdown. Commodities are also slowing down from having some dizzying heights over the past year or so. So that's going to weigh on Malaysia particularly. Does that mean that inflation can come down? Yes, in terms of headline inflation has been trending lower. That's in line with the external environment, what's happening with commodities. However, specific to Malaysia, there are new taxes and subsidy rationalization that could actually reverse this trend in 2024. So there will be a balancing act. It will be hard to say what is really going to be the inflation direction. We do think that we expect it to stay probably around the 3% figure, not to go lower because of some of those cost push from the taxes and subsidies as mentioned earlier. And of course, my forte, what would Fuad outlook be without talking about rates? In this kind of environment, we think that Bank Negara is unlikely to hike in the first half of 2024. There is a cautious external growth environment, as mentioned. Inflation is steady. Well, I've already talked about that. So bond yields in Malaysia are low versus foreign counterparts, and I think it is how to say expensive when you compare to what you're getting from around the region and even compared to some developed markets. So because of this, there's really not that much upside. Maybe with respect to the ringgit, and people want to speculate on the ringgit, but that's really going to benefit the shorter end of the yield curve for all you bond nerds out there. But yeah, I think now that I mentioned about the ringgit, I'd like to hand over at this point to Colin to talk more about everyone's favorite topic, the ringgit, and more. So Colin, over to you.
Thank you, Fuad. As you mentioned, I am the FX guy, so obviously I'll be left to talk about everyone's favorite topic, the ringgit. Just one moment. All right, so I guess the key question that gets asked a lot last year, especially during this whole heightened period of ringgit weakness, is will Bank Negara be hiking interest rates to combat our ringgit weakness? But I think to put that in perspective, we need to think about ringgit, or rather, we need to think about the actual real drivers of currency exchange rate, right? And really only one thing matters, and that is currency flows. So we'll segue a bit into some education here, where we can think about flows, currency flows, as divided into three types, mainly real sector, real economy flows. These are your trade, exporter, imports, and repatriation of profits. Your second category would be the portfolio investment flows, which would be foreign fund managers buying and selling local securities, and to do so needing to buy or sell our local currency. The last bit would be the foreign direct investment flows, things like setting up a new factory in here. Tesla, for example, is looking to build a battery plant here, right? Something like that. So all of these are actually what drives flows on a structural level. And everything else, every single narrative, including interest rates, has an impact on one of these three types. So one thing I want to focus on is actually the portfolio flow section, because they really matter in terms of size. They tend to be chunky. One bond lot in Malaysia, for example, is something like 10 million ringgit per lot size. So you can imagine that a single transaction of a few lots is going to be sizable. Also, fund managers tend to chase performance. They tend to be have a herd mentality. So when one story looks good, everybody just piles in. And on the flip side of that is that when there is a crisis or a de-risking requirement, everybody also goes out the door at the same time. You can see here that as of June 2023, Bank Negara has released our foreign holdings statistics of local government securities. And foreigners hold about 23.2% in aggregate, which is something like 260 billion ringgit over. So you can imagine that a 1-2% de-risking of local currency bonds would have a sizable impact on our currency itself. And that is kind of what we need to address here. So let's talk about the ringgit in terms of this year's context. In terms of real sector flows, we've noticed that those who need to buy dollars against ringgit will do so quite aggressively, but these are mainly your importers. And those with dollar receivables, like your exporters, hoard it. And it's been a very easy trade for them because they're naturally long dollars in a rising ringgit environment, and there's no incentive for them to sell those dollars back into ringgit. I would say that this is probably due to a lack of confidence in the currency. And I guess the China down cycle has also played a part. But what's really interesting is the portfolio investment side of things, where if you think about it, we hear about the negative interest rate differential between the US and Malaysia being a key factor. And yes, this is what they call the carry trade, where it is more attractive to hold the currency with the higher interest rate compared to the one with the lower interest rate. But as it stands, federal funds rate is something like 5.25, 5.5% in that range, and BNM's OPR is only 3%. So a hike is not going to narrow the difference very much. And if you think about it, based on the previous chart, a hike actually serves to hurt our foreign portfolio bondholders by marking to market their bond holdings lower. So that does actually encourage them to sell these bonds and cut their losses and sell the local currency as well. There is also, I guess, a risk that Israel lobbyists would be looking to boycott Malaysia, but so far that has not really materialized yet. And on the direct investment flow side, there's nothing really exciting about 2023 and nothing to shout about in 2024 either. So where do we go from here? I guess going back to what Fuad has mentioned, in the first half, BNM is unlikely to take any action. There's probably very little to shout about in the bond space, and I guess also in the FX space. And I think not hiking for currency reasons is the right move. I'd say that the ringgit will continue to be driven by mainly external factors. And since the last US CPI print, we could see that the US rates, the yield curve has come down a lot. And this has also driven dollar lower versus the ringgit. I don't think it's unreasonable to expect that there will be some strengthening as the entire region strengthens, and ringgit being a very downtrodden currency versus its peers could also strengthen. I do highlight that there could be some unanticipated headwind in terms of our new sort of hardline stance in the Middle East conflict. And overall, I would say that diversifying from purely holding your ringgit in cash is probably a good idea. And where can you park that, right? Well, we as Halogen are obviously fund managers, and that's where we hope to answer your question. So let's go to the meat of the presentation and what is really our specialty in this region, which is cryptocurrencies. This one I can slide up. All right, so I guess Bitcoin has caught everybody's attention this year, and with good reason. It is up on nearly 125% on a year-to-date basis, and has kind of seen sustained strength throughout the entire year. First was the rebound post the FTX debacle, I could say, in November and December last year. And following which, it served as a good correlation hedge against traditional finance when in March, Silicon Valley Bank went under, right? So this was that peak. In June, though, we got wind that reputable fund managers like BlackRock and Fidelity were applying for a spot Bitcoin ETF, and that has more or less driven the performance from here all the way up to here. And it is a very big narrative that's driving the market right now. But yet, does a spot ETF really do anything? I would say that there are competing theories about it. There have been ETFs listed in the past in places like Canada and Europe, but bear in mind that the US capital market is many times the size of some place like Canada. And given where price has gone, the bulls are definitely winning right now. So one thing great about crypto and Bitcoin, I guess, in this case, is that there's a lot of alternative data that you can look at that is not easily available in traditional financial markets. And this chart here is aggregate of some metrics that inform the Bitcoin derivatives market. In this case, what they call perpetual swaps, which are an innovative version of traditional futures products. So what should be the takeaway here is that if we look back to 2022, this was the November low, the post-FTX low, where Bitcoin dropped somewhere to about 18,000 and has since risen. You can see a series of higher lows as price gets supported on the way up. But what's keen to note is that the derivative positioning has not really increased all that much. So speculative derivatives positioning is indicative of speculative activity, and speculators tend to be wild. They drive the price with a lot of momentum. And you see, it's good to note that speculators, while they have been active, have not taken control of the Bitcoin price like they did back in the late 2021s. So you can see here that with speculative activity waning and prices going higher, it's sort of safe to conclude that all of this has been driven by real fundamental buyers. And this can also be colluded with a look at what is called on-chain metrics. We can see here that on-chain metrics, which is an aggregate of, in this case, supply based on actual transaction data and the analysis of on-chain wallets. So this is a chart courtesy of Glassnode, which is an on-chain data aggregator. You can see that readily liquid supply, which is the orange and red lines, has been on the decline for the entire year, while illiquid supply, which is basically those long-term investors who have been keeping their coins away in cold storage, has been on a steady increase. And this has been true as well since the June and July lows, right? Where you can see a very sharp increase in long-term supply and a very sharp decrease in liquid supply. And this would be for two reasons, right? One is the anticipation of the ETF approval, and the second being what they call the Bitcoin halving, something which we'll cover about later. So all in, where can we expect prices to go? I don't have a crystal ball. I wish I did. Then I can tell you, Yasiang, when we're going to the moon. In this case, here are some key levels to look out for in Bitcoin. So clearly, as Bitcoin price has gone higher, we are met with some resistance ahead. And the key ones that we look at are the 40,000 level, which is a pure psychological level, the 42,000 level, which is a meme, ironically enough, and 48,000, which is very much higher, but it's also the previous interim high in 2022 before the break to 69,000. On the downside, we've got support. 35K is the interim, but much stronger at 30,000. Another one at 25,000, which would be this cycle's low. I would say that based on the first two charts, we can expect higher lows in price. That's in the 69420, don't forget. Yes, you can expect higher lows in price. And you can also see that readily available supply is reducing on top of derivative positioning not being very extreme. That said, I don't think we get anything very clear until we get a catalyst. And in this case, it's the spot Bitcoin ETFs. Alex, we'll cover Ethereum in a few slides later. So let's move on. What's going to happen with an ETF approval? There are, according to Bloomberg, there's a 90% chance of an approval by the 10th of January. He has a crystal ball, maybe. But how we think this plays out, actually, is that it's going to be what we call traditionally buy the rumor, sell the fact. And what's going to happen is that you can see that Bitcoin has already rallied so much from the lows and the 25,000 lows prior to the ETF announcement. And there's a very good chance an approval is going to send the price higher, but this will be an excuse for traders and some short and medium-term investors who have already been long to book profits. And instead, what could happen then is you could see capital being redeployed into going long Ether, which is just getting started on its own ETF narrative. And to show that, I guess we have a chart here of the Ethereum versus Bitcoin cross. And let's take the blue line as some reasonable average, that moving average that's been tracking the price for for as long as it's been calculated, right? You can see here that perhaps there's probably a 10 to 15% scope for the ETH BTC pair to retrace. And so we expect Ether to outperform Bitcoin by that amount during that time. That's it. Even though the immediate aftermath of ETF approval may be choppy, there are still some tailwinds for Bitcoin in the long term, right? The ETF narrative may drive speculative demand in the short term, but should also drive newer long-term flows. As the infrastructure gets underway, the product becomes more established and institutions start to adopt it. We also got the US economic cycle that Fuad talked about, expecting slightly easier financial conditions in the first half, and also hopefully a bullish cycle ahead of the presidential election. And the final thing, although it's in the middle here, is what we call the Bitcoin halving, which has a structurally bullish undertone and, funnily enough, or unsurprisingly, an additional bullish narrative to support it. So what is the Bitcoin halving? For those who are new, so the halving is a structural phenomenon encoded into Bitcoin's code, where the block rewards given to miners are halved at every event, thus reducing the new supply of Bitcoin and keeping the protocol deflationary. It occurs once every 4 years, after about 210,000 blocks, and the fourth halving is expected next year, coincide around the 17th of April, and it will occur at block 840,000. We're currently around block 817,000. So in theory, the halving does reduce the supply quite drastically at that. And while theoretically not doing much for demand, miners typically will take their block rewards and sell them to maintain operations. And what that actually means is that you have literally halved the amount of Bitcoin that can be sold after the event. So technically, this would support prices. But that said, it really is more a structural tailwind than a reason to buy Bitcoin outright, because clearly there are so many more drivers that inform Bitcoin's price. So halving is synonymous with Bitcoin's 4-year cycle, since it happens once every 4 years. And we can kind of see that there are very defined periods of upward trajectories followed by downward momentum and period of consolidation. So this is a log chart, by the way. So in case you are wondering why your TradingView charts don't look the same. Anyway, if we take the FTX low as the cycle low, you really could see a pretty large scope for Bitcoin to move. We're already looking at it pushing above 100,000 by this model alone. And I just caveat here that not all models are incorrect, but some are useful. So I do think that in this cycle, if things play out correctly and nothing untoward happens, we do see a new all-time high. Let's see. Right, so moving on to Ethereum. In the interest of time, we'll keep this a bit short. So we're mainly going to look at price. And in this case, we're on the cusp of a breakout. You can see very clearly here that the 2,150 level is good resistance. And Ethereum is really just getting started in its ETF narrative cycle, which is getting accelerated because I think BlackRock believes that they got a really good chance to get their Bitcoin ETF approved. So I would say that we would expect ETH to follow the Bitcoin performance, but with a potentially faster timeline and maybe a little bit reduced in scope. So let's take a look to see, right, that going back to what I said about rotation, is that ETH has lagged BTC in all the news headlines surrounding an ETF application, except for the one where it was specific to the Ethereum trust filing. In there, Ethereum outperformed Bitcoin by about 10%. So if we do get a rotation, there is really a lot of upside from there. Or maybe not, because a lot of it is priced in, but compared to Bitcoin, which will be most likely done, I would think Ethereum would be the one that people would look for next. So just going to wrap up, we've got a quick summary of what to expect for crypto. The ETF narrative is clearly bullish in the long term as well, but risky in the short term. I reiterate again, it's about buying the rumor, selling the fact. And for those who think otherwise, I do well to remind you about what happened when the CME listed Bitcoin futures in 2017, and also what happened when El Salvador actually bought Bitcoin for the first time. In this case, price just tanked. Of course, there's so much hype about the ETF, so what is the biggest risk? And that would obviously be that the ETFs do not get approved. We mentioned structural tailwinds, and this might support the price, but you can really expect a very sharp retracement on any news pertaining to that. Again, structural tailwinds could help support BTC prices, given how we are coinciding with what looks to be an easier US economic cycle and also an election cycle, the Bitcoin halving, and eventual flows from a spot ETF. And finally, Ethereum should be the play everyone is watching out for, and everyone should position for. So even if you could expect a bit more volatility from there. And I guess a bit of a spoiler alert is that we do have an Ethereum offering coming very soon. And that's it. That's all we have for our content. Hope you enjoyed it, and thank you for bearing with Fuad and I on a working night. I will pass it back to Jai.
Okay, thank you so much, Fuad and Colin. So I just want to remind everyone, feel free to leave your questions in the Q&A box below. But before that, before we go into the Q&A session, allow me to share a little bit about what we do and what we offer. So I think I did see earlier that some of y'all are actually new, and you've probably heard of Halogen Capital for the first time. So yeah, maybe Fuad, can you go to the next slide? Next slide. Okay, so yeah, allow me to share a little bit about what we do and what we offer. So in short, so Halogen Capital, we are Malaysia's first ever licensed digital asset fund manager, specializing in digital asset and innovative investing. And at the same time, we are also licensed by the Securities Commission of Malaysia. And that aside, for you to visualize what we do even better, Fuad, can you go to the next slide? So for you to visualize even better what we do, let's take a look at this table. So right off the bat, I'm sure you are seeing, so most of you should be seeing some household names already. So for example, like Rakuten Trade, CGS by CIMB, and then Plus Online for your traditional assets. Then for the digital asset side, we have Luno, Synergy, MX Global, Tokenized Exchange, and then most recently we have Hata as well. So that's for digital asset. And then for the fund management side, we also have your usual names like Halogen Capital, AHEM, Principal, CIMB by CIMB for the asset management side. And so from this table, what can you see? So we at Halogen Capital, we see at the intersection of them, offering you access to both traditional and digital assets as fund manager. So that's in short what we do. So Fuad, can you go to the next slide? So now about in terms of what we offer, so I think Alex has a question on that. How many funds do we have right now? So in terms of what we offer, just to share a bit, here are some of our flagship Shariah funds. So as you can see, we have the Halogen Shariah Bitcoin Fund, which is an Islamic wholesale fund that invests almost 99% in Bitcoin. And for the second one, which is the Halogen Shariah Ringgit Income Fund, which invests in Islamic deposits and short-term sukuks. So at the same time, if you can see on the table, we also have the Ethereum fund coming up really soon. So yeah, if you're curious and you anticipate for the launch Just be sure to follow us on our socials, and you'll be first to know when it's launched. Right. So this is a little bit about what we do and what we offer. Now, for all of you here, I see that there's still quite a number of you who stayed through the webinar. We have a very special deal for all of you. So, Fuad, can you go to the next slide? So, for those of you who are still here, we have a very special deal for you. So what this deal is about is you can get a 1% bonus reward for 1% bonus Bitcoin units for investing in our Halogen Shariah Bitcoin Fund. So, but the caveat here is as long as you have to invest by the 30th of November 2023. So isn't this a super deal? So as long as you get 1% extra on top of your investor amount. So, long story short, if you want to get started, very simple, just scan the QR code that you see on the screen right now. Or if you're on your phone, simply head to the link that we have on the screen and get yourself onboarded through our Halogen wallet, right? So you can do that. Or if you feel that, okay, you still need more information, you're not too sure how to navigate this, feel free to go to our website and drop us your information there. We have a form for you to fill out, so feel free to drop us your information there, and we'll get back to you in one or 2 days. So yeah, I think for those of you who have always wanted to get into crypto, do seize this deal. So we only have this campaign running until the 30th of November. So seize this deal. Okay, I think that's a little bit about what we do and what we offer for you all to understand. So now let's get into the questions. I think we have some questions earlier by US Yang. So yeah, first question. So in a US Fed fund rate high for long scenario, assuming flows stop moving into Asia EM, counties with fiscal deficit will have to be financed locally. So do you see a scenario where household savings end up financing all the deficits, especially in a country where there is mandatory retirement savings? So maybe Fuad or Colin wants to take this. Fuad maybe?
This is a tough question. It does go kind of deep, I suppose. I will say this for sure. What I do know for sure is that Malaysia does have the ability to finance locally a lot better than a lot of other countries do in EM Asia. And that goes for saying in the bond markets, especially, we've got a pretty deep ringgit bond market where even foreign companies are actually issuing in our market, like in Turkey, from Indonesia and all that, actually issuing in Malaysia. So that's quite unique compared to somewhere like Thailand, where it's not that easy for all kinds of corporates to issue bonds. And also in Indonesia, where they tend to stick to US dollar funding. So they will also get hit quite badly by the high rate. I don't think there's a lot of household savings in Malaysia anyway, and there's unlikely to be so going into next year with the kind of cost push that's coming up. I mean, you've seen what it's like in terms of EPF balances. You might have seen that on average, it's pretty low. So I'm not sure if that's really going to come through, but we do have a lot of GLICs, and they still are relatively flush with liquidity, and they're being given mandates not to invest overseas and to try and take profit from there and then reinvest locally to try and help the ringgit. So I do think there is going to be some kind of flaw in terms of that. So I'm just going to talk about it specifically from the ringgit perspective. Don't know if Colin wants to add anything to this.
I guess I'd only say that, well, it really feels that we are already funding it, as the tax base is low, and you can see that our deficits are always in focus, right? So that is the base case, but I guess even if Fed fund rate remains higher for longer, generally what you get is probably something of a narrative where the market always tries to be 3 to 6 months ahead of where policy is going to go, unless in this case, the Fed is totally playing chicken with the market, right? So I I would say that funds, or rather portfolio inflows, will still find its way into this region. Just a matter of timing.
Yep.
Okay.
Thanks, Yuxiang, for the question. Yep.
Thanks, Yixiang, for the question. Hope that answers your question. So I think he has another question. So probably this is more to Colin. So if everyone's looking forward to the confirmation of the spot ETF event, so would that event still have an edge in price action? Would the market already run ahead of itself?
Thank you. The answer is yes, in the sense that this market is very momentum driven, but we go back to what I mentioned about buy the rumor, sell the fact. So you're right, there's already been a big run up. I would expect that actual confirmation to run into resistance at the levels where we identified. So which is why I said you'd be looking to rotate into Ethereum, which is still sort of like in the early stages of that narrative play, because everybody who has been ahead of BlackRock and the market has already bought it. And yes, while liquid supply has moved, it's been spot driven, what I would expect is that at 40, 42,000, 48,000, you're in great profits. You would be pretty irresponsible, although that might inform a good portion of the crypto market, not to manage your money correctly. So yes, I would say there will be a momentum-driven edge, but it will be very short and it will be run over pretty fast.
Okay, so that's for you, Yixiang. So now I'll head to the Q&A box for a little bit. So from anonymous attendee, if growth is slowing and inflation remains under 3%, what can Malaysia do to defend the currency in 2024?
If it's all right, I'd like to add my little 2 cents into this question. I think the reality is that from a policy making perspective, I don't think Malaysia may want to defend the currency. Don't forget that exports are actually quite a big lifeblood for the country. And even though we have a weakening external environment, there is a need for competition. Because of that deglobalization, Malaysia is one of the beneficiaries, especially in the E&E supply chain. So by having a weak ringgit, it can help to make Malaysia a bit more attractive vis-a-vis this kind of supply chain. So yeah, I think we do have to perhaps recontextualize. Sometimes we see what we see in terms of urban areas and all that, but in terms of the whole Malaysia and what benefits Malaysia as a whole country, a weak ringgit may not actually introduce that much inflation to outside urban areas where we tend to have a bit more imported stuff. Of course, yes, there's a little bit about food security, but I'm just talking as a whole lah, just my 2 cents.
So I'd like to add a bit more color to that. So first of all, Fuad is right that perhaps BNM will not be so keen to defend the currency, especially if it's a rest of the world thing as well. If Malaysia is weakening solely, then yes, I think they generally benchmark themselves against a basket of currencies. And if all of them are weakening versus the dollar, they will usually not be very heavy-handed in that. We've also mentioned that we are more or less at the mercy of the external environment. So the unfortunate thing is BNM probably is happy to, or rather is forced to live with a bit more volatility and a bit more weakness. But the question is, what can we do to protect ourselves from depreciating currency? And the answer is literally to diversify.
Okay, thank you, Colin and Fuad. I think let me go. We have some questions on our funds, and then maybe let's a few questions, especially on our funds and also the benchmark returns. So maybe Fuad, you'd like to take this. So basically from Alex, how many funds does Halogen have right now? And what kind of benchmark returns that we're looking at? So I think there are a few. Another one on your fund return. Is it based on the cryptocurrency price appreciation, things like that? What is the expected return and risk from Halogen fund management? So,
that's a lot to unpack at one go. Unfortunately, I don't know if this is true, but apparently men are not good at multitasking and they only do things one at a time. So I will follow that adage, and I will only tackle these one at a time. What is the expected return from the Halogen fund? So I've pulled up our fund offerings on the screen here. There's obviously one that's not ready yet, which is the Shariah Ethereum fund. That's coming soon. Loosely, what's available for the public to invest is the first and the third row, the Bitcoin fund and the Ringgit income fund. Let's talk about the Bitcoin fund first. This is an exposure product. It gives you exposure to the underlying investment, which is Bitcoin. So it aims to be fully invested in Bitcoin. And so the aim of the fund is to, in a sense, mirror the performance of Bitcoin. So if Bitcoin goes up over the past, over the past 2 months, it's gone up 40% in ringgit terms, then the fund should also be doing the same. And if it unfortunately goes down, then it should also be doing the same. But what we do is we give access into Bitcoin in a manner that's easier for you, in a manner that you don't have to worry about being charged super high spreads on exchanges and stuff like that. Of course, there's a little bit of cost involved, but hopefully we can give that cost back to you, as mentioned, over here in our promo. I'd like to flash that again. So yeah, we are happy to share in terms of the earnings with you. But okay, moving on to the second one, which is the Shariah Ringgit Income Fund. And this is really just about providing liquidity. It's not meant to make anybody a millionaire, but it's meant to be a place where if you feel like you've had too much of a wild ride, it's been too volatile, you want to park somewhere, you always can feel free to switch out of the Bitcoin fund and into the Shariah Ringgit Income Fund. So this one does have a benchmark, which we're beating so far. And the benchmark is the 1 month fixed deposit rate from Maybank. Which is, if I'm not mistaken, is currently at about 275 on a 1 month basis. And if I'm not mistaken, on an annualized basis, this fund is currently getting above 3% at the moment. So that's the kind of thing that you're looking at. You can treat this like an FD, except that you can actually get daily liquidity from it. And of course, how do we achieve that? We have to actually put some into Sukuk. It is investing in bonds. It is investing in Shariah compliant bonds. So there is a little bit of market risk, but we try to make it very balanced. And so far, I think we've been doing a good job. On some weeks where bond market is down, we're steady. On some weeks where bond market is doing very well, we're also quite steady. So yeah, I hope that answers in terms of the expected return. What's the next one to tackle? Okay, I'll take the one from Josh E over here. In terms of your fund return is based on the price of cryptocurrency appreciation. I think I do believe I've answered that in terms of the Halogen Shariah Bitcoin Fund. Once again, if Bitcoin goes up 40% in ringgit terms, then this fund is likely to do almost the same, like 99% the same, right? So yes, it is going to track Bitcoin in that manner. I believe I'll answer that as well. So yeah, I think I hope that covers all the fun type questions. Maybe let's move on to one more spicy and interesting one. Jay, over to you.
Okay, so back to the Q&A box. So by Victor, do Halogen do all the crypto trading through Malaysia Digital Exchange?
I'll take that one. So the answer is yes and no. We do trade through the local exchanges, but we are not bound to trade with the local exchanges unless it is specified in our mandates. So the Shariah Bitcoin Fund is currently the majority of its trading currently with local DEXs, but as you can see in the list of funds, we do have other private mandates where we are not limited to trade through our local digital exchanges.
Okay, I think the one on fund benchmark is answered. So I think third one is how does Halogen Fund maintain its transaction costs low, and do they have the mandate to invest in any altcoins? Okay, interesting. Altcoins. Okay.
I'll take
Can I
that
give
again.
an overall view first? The short answer is with a lot of work, with a lot of hard work by the people here wearing this shirt, especially the investment team. It takes a lot of watching the market, looking out there, and looking for what's the lowest cost way of doing it. But yeah, Colin probably definitely has a much better answer for you. But that's the short answer.
Short and sweet. So I don't think there's more to add to that. I will also say that it's also the strength of an institution and the backgrounds and experiences that we have. We do know how to navigate this environment. As for whether we have a mandate to invest in any altcoins, not yet, but I'm pretty sure there will be. Although I guess going back to the first part of the question about how do we maintain low transaction costs, I would say again, it's the institutional backing that we have and also the experience, but it's also the difference between trading as a retail guy versus trading as an institution, in the sense that the transaction costs and the fees that a retail person has to eat up on his own is many times more than what we get. And that's probably one of the reasons for considering a fund over a do-it-yourself approach, especially in Malaysia.
Okay, we have one more question by Dolly. So what is the minimum investment and how long do you suggest to keep it at minimum? By Dolly.
Hi, Dolly. Fuad here. So in terms of minimum investment for the funds, any of these, there is a minimum of 10,000 ringgit. That's pretty low considering it's a wholesale fund. And wholesale funds are only offered to sophisticated investors. But not to worry about the details, please, if you're interested, get in touch with us. We can walk you through all these little details about what's a sophisticated investor, all those kind of things. We can walk you through that. And also, when you talk about how long do you suggest to keep it at minimum, I will assume that you're talking about what kind of recommended investment horizon do we have. And to that, I will say that it is important to actually do the suitability assessment. We have a suitability assessment, just kind of like how every other asset manager has as well, where we kind of go through and try to understand your risk appetite, your risk tolerance levels. And based on that, then we can really look into how long to keep it. But generally, if we're talking about the Shariah Bitcoin Fund, this is a high return but high volatility asset. So this does, even in our own internal classifications, fall under the aggressive category. And for aggressive category, you would need to score a pretty high score in terms of the suitability assessment, which means, amongst other things, of course, is not the only factor, but one of the key factors is that you have a long-term investment horizon, maybe even stretching up to 5 years, as an example. Of course, I do recommend, please do get in touch with us. We can go through that suitability assessment together, and then we can see whether it's really suited for you, whether it's really suited for your particular risk appetite. Yeah.
I
Okay.
will just take the last two questions if you don't mind. So we've got one from Dolly as well about whether you can invest into Halogen funds via the Halogen wallet or any other crypto wallet. So to answer the question, our Halogen funds are real world funds, right? They're not a crypto protocol or a token, at least not yet. But so our Halogen wallet is a portal for our investors. It's not compatible with something like Trust Wallet or MetaMask or any other form of cold storage. So in that sense, we are here we are basically a local fund, a local asset manager, which allows you to invest ringgit and get crypto exposure. We custody it for you, and when you want to cash out, we'll give you back ringgit. Although potentially we could give you back something else if you ask for it. But yes, for now, you can only invest in Halogen funds via ringgit and also via our Halogen wallet or through any of our sales reps. Do not try to connect to us using MetaMask. Last question goes out to Josh. What if it goes down? Pray. No, in all seriousness, our fund is meant to give you exposure to Bitcoin, right? And while we are, we have experience in this space, everybody's investment and risk appetite is individual to them, right? You've got to basically invest what you're comfortable risking and maybe losing. So in terms of plans to hedge against it, not for this fund, in the sense that we might just let the cash portion of the fund build up slightly, but overall we are supposed to give you exposure to Bitcoin and Ethereum eventually. And if it goes down, if Ethereum goes down, Bitcoin goes down, the fund goes down, plain and simple. The alpha management would come under private mandates, where we take discretionary measures to hedge portfolio performance. And that's more a trading discretionary mandate. I'll just pick off the last two and that would be it. What's management fee like? For the Halogen Shariah Ringgit Income Fund, it's 40 basis points, 0.4%. For the Shariah Bitcoin Fund, it's 1%. And yes, we are SE regulated and SIDRAC insured.
So,
And I guess lastly, there is no leverage for the fund because it's a spot Bitcoin fund.
Yeah. I just wanted to put out something here for Victor, if he's still around. Victor AY. So I'm not sure how to pronounce that, so I'll just spell it out. Yes, you know, as we talked about here, some of the funds here, especially the Bitcoin fund, is a tracker fund, is a sort of a relatively passive strategy. However, as you see on the screen right here, the fourth column, the fourth entry, the fourth line, we do have private mandates, and we have already started our private mandate business at Halogen, slightly over 1 million in private mandates, ringgit wise. So yeah, if you'd like to have a strategy where the downside is managed, please do get in touch with us. We can actually dig a little further, have a conversation, and try to understand if we can get closer to your needs.
okay, I think that's all the time that we have. We send this to everyone. Okay, before can you go to the last slide? So yeah, so I think those are the questions, and that's all the time that we have for tonight. So for those of you who are still here, thank you so much for being with here up till now. Then we have a lot of questions on the funds, and also and how can you potentially invest as well. So what you can do is just scan this QR code and you'll be directed to our contact us form. So in the contact us form, you can simply fill out your details, and then our sales team will get back to you in 1 or 2 days, in 1 or 2 business days. So yeah, at the same time, if you're curious and you also want to stay updated with our funds and our launches, our product launches, fund launches, so just follow us on our socials, so you can check out all of our, we are very social, so just check out all of our social media platforms that is listed here. Then you can stay updated on what we what we are launching and everything. So yeah, I think that's all the time we have. Let us know if you have any questions. Just drop us your questions. I mean, just contact us, and then we'll get back to you. So yeah, I think that's all the time that we have. Thank you so much, everyone, for joining, and do stay tuned for our next one. So have a good night, everyone. We'll see you all soon, the next one. Bye bye.
Thanks, everyone.
Have a good evening.
Have a good evening, everyone. Bye bye.